It happens in a flash. One number, a sea of red, representing billions of dollars just gone. Wiped out from what was supposed to be the safest investment you could make. And look, this wasn't some flashy, volatile tech stock. This was a historic crash in gold and silver, the very assets people run to when they're scared.
Okay, let's get right into it. Welcome to The Explainer. Today, we are going to break down how a so-called safe haven can suddenly become the epicenter of a financial earthquake.
So, you'd think the trigger for something this big would have to be a war, right? Or some kind of natural disaster? Nope. It was just the nomination of one person, Kevin Warsh, to be the new head of the Federal Reserve. So, how on earth does that happen?
To really get why things fell apart so fast, we first have to understand why gold and silver were absolutely shooting to the moon in the first place.
Well, the main reason was this one big idea, debasement. It's basically a growing fear that the US dollar itself was losing its value. And when that happens, investors start looking for what they see as real, hard assets. You know, this wasn't just about spreadsheets and numbers. It was a feeling. It was a loss of faith. People felt like the dollar just wasn't a sure thing anymore. And that rush into metals, it became the biggest, most popular trade of the year.
And this analogy just perfectly captures the danger. When everybody is making the same bet, the market gets incredibly fragile. It becomes what traders call a crowded trade. And that's exactly what it sounds like, a room full of people with only one tiny door to get out.
So we've got this fragile, crowded market. Now let's talk about the spark that someone threw into that room. Because a new Fed chief, well, they can act like a massive power switch for the entire market.
Now, to really understand why everyone freaked out, we have to talk about this key concept, real yields. Think of it like this. Gold pays you nothing to own it. It just sits there. So it starts to look a lot less attractive when you can suddenly earn a real return, a return that's higher than inflation on something super safe, like a government bond. Exactly. And this nominee, Kevin Warsh, he had a reputation. The market saw him as a hawk, someone who would get tough on inflation by raising interest rates. And the second his name was floated, the market instantly priced that in. Higher rates mean higher real yields, and that makes holding zero-yield gold a lot less appealing. This one phrase just captures the panic. For years, there was this belief in something called the Fed put. It was like an unspoken promise that the Fed would always step in and save the market if things got too bad. But with a hawk like Warsh potentially in charge, poof, that safety net was suddenly gone. So here's the really crucial part. We have to understand how a simple price drop, which was just based on expectations, turned into a full-blown mechanical crash. It becomes a domino effect, a vicious cycle. And leverage, that's trading with borrowed money, is the gas on the fire. It's like driving 100 miles an hour. It feels great until you have to slam on the brakes. Suddenly, the selling wasn't a choice anymore. It was forced. And the sheer scale of the destruction here, it's just breathtaking. In less than 24 hours, literally trillions of dollars in market value just vanished across all precious metals. And you might be wondering, okay, but why did silver and platinum get hammered even worse than gold? Well, it's because they kind of have these split personalities. They're not just seen as money, they're also crucial industrial metals. So they're way more vulnerable to fears about the economy slowing down. This quote, wow, it just perfectly captures the brutal, cold-blooded mindset of the market. For some people, this crash wasn't a disaster at all. It was a fire sale, a huge opportunity. So after all the smoke has cleared, what have we actually learned from this? And maybe more importantly, what are the questions we should all be asking now? I think if there is one really important lesson here, it's this. In the short term, markets aren't driven by logic. They're driven by positioning, leverage, and expectations. That safe haven label, it won't protect you when the stampede starts. Okay, so this brings us to our first big knowledge gap. Are the really big strategic players, like central banks around the world, are they actually out of the game? The answer is probably not. They play a much longer game, one that's very different from the fast money that caused this whole crash. And this leads to an even tougher question, our second knowledge gap. How can you tell when a trade is getting too crowded? At what point does a really good idea turn into a dangerous groupthink situation that's just waiting to blow up? And that leaves us with one last big idea to think about.
If trust and perception can be shattered in an instant, in a single news alert or a tweet, then what does safety even mean in today's markets? Is any safe haven ever truly safe?